Now, I don't know about you, but one of my favorites in life has been the humorist, American humorist and author, Mark Twain. And he pointed out something that I thought was appropriate, and many times for some of the cases we're involved with, which is what really gets me and gets you in trouble is not what we don't know. It's what we know for sure. That just ain't so. So for how many of us do we think we know that 1031 exchanges, if we have a client that's selling a home, and in some cases we can do a 1031 exchange even for a portion of a personal residence, but for a rental home, for a second, third home, or obviously income properties, apartments, so forth. How many of you know that to everyone, there's more than one way to do things? So that's what I'm going to be sharing about today, is some alternatives to 1031 exchange, and why today is probably the worst time I've ever seen to try and do a 1031 exchange. So, okay, let's talk about 1031 exchanges and a few of my favorite alternatives. But just to let you know, there are 8 to 10 different alternatives to doing a 1031. So it's not just one or two more, there's a whole bunch more beyond the scope of our time today. And again, that's why I'm saying this is not here to make you an expert. What it's really designed to do is for us to be able to begin a dialogue. Olha Martinez, our marketing and event manager, who you've been seeing and hearing from, she'll be reaching out to you, or Dan in our office as well, or my wife Vivian. We can chat about any client situations you might have, and we offer a 20-minute complimentary conversation just to brainstorm on a situation, either with you and your client, or a call from one of my realtor friends yesterday, RJ, I've got a doctor who's selling a business or is building. Could there be some things for him there? And so we're also going to be sending this webinar to them as a way to be able to introduce and then bring my real estate friend in so he can sell the property. What a great idea. Anytime that you want to reach out to us, my wife's email is there, Vimian@Wealth Legacy Group, and we can set up that time as well. So let's get clear on the typical plan, which is for those that try to use a 1031 exchange, what is it exactly? One of my best friends, and who's one of the top 1031 exchange accommodators in the country, Bill Exeter, here and also in Wyoming. He likes to talk about swap till you drop, which just means that you continue to take and trade your old property in for new property. But there's some real problems with that, and we'll look at that in just a minute. Now, one of the reasons he says swap till you drop, meaning that at death, the basis in an asset gets a step up in basis. President Biden was threatening to take that away. Fortunately, that we still have it. So, and I think going forward, we will continue to have it for quite some time. So you could buy an asset for 100,000, and if it's worth $1 million when you drop dead, guess what? It's worth $1 million, and you sell it the next day, and there's no tax. Now, unfortunately, though, in California, as many other states we work in, we find that people are using joint tenancy with rights of survivorship to title their real estate assets. And if you've got a married couple you're working with, or if you are married yourself, you do not want to title your real property, or frankly, your other appreciated capital assets, as joint tenants with the rights of survivorship. You want it titled as community property with rights of survivorship. Put it in your living trust, make sure it is titled as community property. That way, not only does the first person who dies get a step in basis, but the surviving spouse, who presumably is still alive and kicking, also gets that same step up in basis, so they can sell the asset the next day and pay 0 capital gains tax. So pretty clever thing, but you got to make sure to tell your clients, advise your clients on this, or we can, but especially for you, do not hold your property in joint tenancy. So what are some of the typical issues? Well, 1031 exchanges themselves are very complicated, and they offer truly very little flexibility. You have 45 days maximum to be able to identify your replacement assets, what you're going to try and replace into. And everything has to be all settled with the bow on the package within 6 months. And I've done 1031 exchanges. They are stressful. And I've got to say, many of the assets that you identify, especially right now, aren't even available once you come around to closing, because they're moving so rapidly when they do so. As I said, it's the worst time I've ever seen to try and do a 1031 exchange. There's so little inventory, and what is available is overpriced, and there's usually a reason why it hasn't been sold yet. Oftentimes it's also on the other side of the country. Now, here's one of the other big things that many people don't think about is you have to carry over your basis into the new asset. So if you've had that asset for a while, you probably have very little shelter on the income stream that's being produced because you've used up all the depreciation. So, and you can't depreciate land. So when you do a 1031 exchange into a new asset, you have to substantially increase the market value to be able to get any new depreciation. And even then, it's limited. So it's, again, complications that I don't think if there's another way to get around it, you'd like to get around it. And I might also add is that I've had more than a few people saying, RJ, I want to sell, but I don't want to have to buy more real estate again. I'm not sure this is a great time to be buying more. And I have to say, in some situations, that's very true. So what if you want to invest in something else when you sell? Can't do that with a 1031 exchange. Under the Tax Cuts and Jobs Act, they restricted further 1031 exchanges to only be for real estate. It used to be could do it with planes and some other things. And the real estate has to be in the US. It can't be in Mexico or some of the other places. It can't be in Canada. So all that, are there any other options? And the short answer is yes, which is why you're here on our webinar today, probably. So I'm going to give you 3 case examples. And then also, I know that there are people who have already had liquidity events this year, went ahead and did not use a 1031 exchange. They're going to be paying taxes next year. Is there anything that they can do? And the answer is yes, even after the fact. So let's talk about Foolproof 1031. Let's talk about one of my true favorites, which is the 30-year tax deferred installment sale. That's my name for it. You won't find it in the dictionary that way. Capital gains alternative trust. That's also one of my favorites, and that also is my name for it. So you won't find that in the dictionary either. And then, as I alluded to, post-sale tax planning. What can you do after the fact? After you've jumped out of the window and you don't have a parachute, what do? Well, there's a net we can put it in the bottom. Okay, well, let's talk about what I call the Foolproof 1031 exchange. And the Foolproof is this. We combine the 1031 exchange, but with something called a Delaware statutory trust. And I've got several articles on this if you want to read more about what those are. But it's for the clients that are tired of the 4 T's, the tenants, termites, taxes, and toilets. And so they want to get out of real estate. I'm chatting with a gentleman right now that has $20 to $25 million of real estate. And he said, RJ, I just want out of real estate. Well, 1031 obviously is not going to work for him. And so what counsel is he getting? Well, basically people are just saying, the CPA is saying, you're just going to have to pay the taxes. That's not a good answer. That's not a good answer. And Congress doesn't say we have to do that. They give us other alternatives. So a very simple one is this. We use Section 1031 for either all or portion of the sale, but we identify a triple net lease product, or what's called a Delaware Statutory Trust, what I sometimes call the good DST. There's another type of DST that's a little bit more problematic. But you name that as one of your 3 selections for that 6 weeks. Now we have to match up that Delaware Statutory Trust with the current debt on the property. So if the property is at 50%, okay, we need to find a DST that is also around that 50% debt margin to be able to use it. But that's fairly easy to do. The challenge is these Delaware Statutory Trust programs and sponsors that we work with, they have a hard time keeping inventory. Stuff is moving so fast because this is such a popular way to now today have and identify and qualify for 1031. Now, one of my very favorite sponsors, they only work in what we call recession-resistant real estate. And the proof in the pudding on this is they've done 55 projects so far. In a minute, I'll tell you who they do them with. And they've always paid on all of those projects. They have never once failed to make the payment that they projected to pay. And in fact, in most cases, they pay more. Now, part of the reason is because the tenants they work with, Walmart, CVS, Kragen Automotive, dollar stores, and other companies that are highest quality credit rating, and they make their payments. So even if they've had to close some stores down, Walmart will make the payments. So that's one of the reasons why, that's the biggest reason why they have never failed to make their payments to the investors. Now, today, because there's so much competition in this marketplace, Last year, I was able to get clients returns right out of the gate at over 6%. Right now, on the newest products, it's down about 5% net of all fees. But a couple things. Number one, 60 to 70% of that income stream, not taxable. It's sheltered by depreciation, and there's a low amount of a low amount of debt that's used on these projects, 30 to 40%. Not enough to jeopardize the product and the programs, but just enough to give a little bit extra kick and be able to give a little bit extra deductions. Now, depending on what the tax bracket is, most of our clients are in a combined federal and state bracket of 45%, which makes the tax equivalent return almost 8% net. And the beauty of it is that they've also got some annual rent escalators, usually 3% per year. At the end of typically 4 to 5 to 6 years, that whole portfolio of about 35 to 45 different properties is sold or put into a big publicly traded REIT. And then the investors are given the choice of being either just to get all their cash out at that point and pay tax, or sign up again, or do some of both. So on top of that, what's beautiful about this is so simple. Clients have no management worries, none of the 4 T's, and there's no liability. They just, every month, a check shows up in their mailbox. Now, I've got to say, on to our second idea, this idea, I was a skeptic of for the first couple of years that I was reading through it and talking with tax experts. I myself have a master's in financial services with a subspecialty in tax. And some of you know that I have a whole bunch of other credentials behind my name because I just want to know, and I'm a skeptic. That's one of the reasons I've been in practice over 35 years and never been sued. But this one finally won my heart. And this is a strategy. I've got to say, your CPA, whoever you're working with, your tax professionals probably do not know about this particular variation on theme. They should, but they don't. But hey, it's more business for us. So let me give you a quick backup. Installment sales, and this comes out of Code Section 453, as opposed to Code Section 1031, but Code Section 453 is all about installment sales. And installment sales have been with us almost since the inception of the IRS tax code. So we've had this around, but it got a fresh look over the last couple of decades. And in particular, one of the biggest ones in the last couple of decades was Boise Cascade. I'm a kid from the Pacific Northwest, and everybody knows Pacific Northwest and Boise Cascade that lives in Pacific Northwest, Boise Cascade. They're now part of Office Depot, Office Max. So they made a transaction of $1.6 billion worth of timberland in 2005, and they paid no tax. That is Office Depot, Office Max, paid no tax until 2020. So for 15 years, they got the cash from the sale, or the bulk of the cash from the sale, and paid no tax. How did they do that? They did it this way. Their corporate lender, which is a household name, institutional and international lender as well, said, look, we'll give you the bulk of the proceeds from that sale via a loan and pay us the interest only. So that's just like when you borrow money to buy an apartment building, you borrow money to buy a house. Do you have to report that loan as taxable income? And the answer is, of course not, because it's a debt and you're leveraging, and the property is collateral for the loan. So fast forward to today, or the last 8 to 10 years, the concept has really been fine-tuned significantly since then. And now what's available is we have lenders willing to play in the space that offer what are called limited recourse loans. Limited recourse loans, meaning that in this case, our seller pays the first month's worth of interest on a loan. The interest rates right now are at 6%. They've been at that rate for the last 5 years. So first month of interest, and after that, the seller has zero responsibility. In fact, the loan documents completely release the seller from any future liability. They can only get payments of interest, and only from the intermediary, what IRS calls the dealer intermediary. Why does a 1031 exchange work? Because you don't get the money. There's a dealer intermediary that's between you and the buyer, and that intermediary then takes your proceeds and puts it into your new investments. Well, in this case, there are dealer intermediaries out there that are willing to do this for 30 years. 30 years. So they're in the gap They make the payments of interest-only loans, and at the end of 30 years, the loan gets reported. But what's really interesting on this paperwork, and believe me, I had our in-house attorney and myself, we scoured these things. The lenders are saying, look, we're completely releasing you from any future liability. So even if the intermediary goes bankrupt or whatever, doesn't matter. We're completely releasing you from liability, except the first month. And that's what qualifies, gives it a basis, gives the seller a basis in the whole program. And that's what IRS is looking for. So let me give a real quick example of selling outright versus using the 30-year tax deferred installment sale. And by the way, I'm talking about a little bit of a lisp. I did have jaw surgery 4 weeks ago. I got a bunch of stuff in my mouth. So it's really hard for me to say some words. So if I don't usually speak with a lisp, but I do right now. But it's coming out. I hope you can hear me okay. So here's a quick example. So this was a $2.9 million project. The basis after depreciation, factoring depreciation and so forth, was about 1.4, about half of it. There was a loan back to the owner of the property. So the property itself and the LLC owes money back to the original buyer, who is one and the same person. The combined federal rates for selling an appreciated asset in California are outrageous, but that's another point. So long-term capital gains federal is 20%. California, we've got a 13.3% because there is no long-term capital gains tax rate in California. It's all ordinary income. They're talking about raising the rate even higher, but okay, that's just California. Plus, there's another 3.8% Medicare surtax, thank you, President Obama, that got added into this as well. So you put it all together, and it's just over 37%. The estimated closing costs on this were about $100,000. So the taxes on the sale would have been over $500,000, or net cash into the seller's pocket of just over $1.4 million. Now, what about the 30-year tax deferred installments? Well, same thing. Sale price $2 million, closing costs $100,000. But then the commercial lender comes in, makes that limited recourse loan of $2.6 million. From that, there's a 1% fee paid to the lender one time. There's the first month's interest of, again, 0.5%, 6% divided by 12 is 0.5%, and that's it. There's never going to be another interest payment from the seller. We're paying off that loan, that $850,000 to the owner, and that leaves net money in pocket of 1.7. Now, we advise, so even though the tax is not due for 30 years, the tax doesn't get worse. So if the taxable gain was $500,000, it stays $500,000. But tax rates can change over time. They don't usually go down, they usually go up. But so we advise setting money aside anywhere from 6 to 7 to 8% of the proceeds, putting it into an account that will grow tax deferred, available for largely tax deferred. There's a little bit, 1 to 2% typically per year, but for the most part, it's in the annualized returns over 30 years have been over 11%. So we project usually about 6 to no more than a 7% growth rate. Now the point is, we're creating a lot of money over in the sinking fund or side fund. Still shows up an asset for the client. If they get in trouble, or if they just need or want to take money out and use it for something else, they can. So it's completely optional, but we like to show it, and probably 75% of our clients that use this strategy do end up creating a sinking fund. But let's just say we do, still the net in their pocket, fresh cash. And since most on the call today are all real estate professionals, can you negotiate a better deal when you're coming with cash to buy a new property? And the answer is, you can, right? Don't you love those clients that come to you and say, hey, I'm coming in with all cash? Yeah. So same thing. In this case, we're giving fresh new cash. We're not carrying over an old basis. And so if they want to go buy some more real estate, you can negotiate a much better deal with that. But the advantage using cash, just purely cash in their pocket, even after creating the sinking fund, is over $200,000 more. So it's over 10% more just on this size of a sale. Okay, that's what I said. Love this one. It's super easy to do. I like to get 30 days advance notice that somebody's selling something. We've done it as short a time as 10 days, but that is really a frantic sprint. Some other ideas, we need a 3-month, ideally, landing strip to get it in place, but that one can be very quick, actually. So keep an eye on the time. Here's a third example. This was a triplex in Los Angeles that was brought into a couple of years ago. The purchase price originally when they bought it years ago, and you'll see in a minute, was $500,000. The basis when they came to see me was $35,000, and the market value was $2.1 million. So you can see it was a couple of years ago, a few minutes ago. Now, current facts today is the net rental income was $52,000. None of it was sheltered because they basically had everything depreciated. He was 70, she was 65, no interest. The spouse had no interest in managing the property if something happened to her husband. They were modest givers as well, and to their church and to a few other charities. So we were looking at either selling outright, and what would that cost? There would be a massive, what I call involuntary philanthropy, also known as taxes. Yep, plus some additional costs. Or, so in this case, they were estimating $100,000 settlement costs, $750,000 in combined taxes. And for them, they just wanted off the 1031 exchange. They did not want to do another 1031 exchange. And I get it, especially with your clients and my clients as they're getting into their 70s and 80s. They don't want to do another 1031. So I proposed a capital gains alternative trust, meaning that capital gains taxes, we don't have to pay them and we won't go to jail if we do something else instead to give back to help our country. And so the concept here is the government in the 1969 Tax Act, or the Tax Reform Act, gave us alternatives. If we want to support the social well-being of our country in a way that's more in alignment with our own value system, we can actually opt out of paying capital gains taxes. They are optional. Same thing with estate taxes, by the way, or inheritance taxes. They're optional, and a bunch of other stuff. This gets in a whole other conversation and love to share it with you. But we can sell an asset in a capital gains alternative trust and pay zero in either federal, state, or Medicare taxes on the sale. Now, in this case, I structured this at a 6% payout rate. We're actually earning more than that, but we're paying out at 6%. So the first year, their income out of the gate was over $120,000. And remember, they were only getting $52,000 a year and thought that was a pretty good deal, frankly. They did. I didn't. But on top of that, because there is some philanthropy involved in this particular type of structure, eventually, maybe 100 years later, but there is some philanthropy involved. The tax deduction from this idea for that same 2.1 million after the 100,000 in closing costs was $1,386,000 in terms of this was done here in 2022. And you get as many as 6 tax years to offset your earned income with that income tax deduction. In many cases, it's just so great that we can't even use it all up. The money that's in the trust, completely protected against creditors, and you can also buy real estate inside the trust and even get bank financing for it. How about that? And you cannot do that. A lot of times I ask, RJ, is this a charitable remainder trust? No, it's not, because you can't do that inside a charitable remainder trust. $1 blows the trust up. So no, this is not a CRT. But ultimately, there is a charitable beneficiary, but that could be, and oftentimes is, the family charity, a family giving fund. And so it involves multiple generations in future philanthropy. Now, I'm getting close to landing the plane here. So I want to give this to you because you're going to be in situations where you've helped clients with a sale and they got a lot of tax to pay. But what do? So we can actually create deductions after a transaction using that last idea. So these clients hired me a couple of years ago. Unfortunately, it was 30 days after they had sold $7.5 million worth of land and a business. They created, unfortunately for them, $2.1 million in taxes. Now, they happen to be also very philanthropic people, and they're actually just absolutely amazing, lovely people. But we were able to create, with 2 different strategies that I don't have time to get into, over $3 million of income tax deductions. $3 million. Now, that wasn't zero. We took their tax bill down to $937,000, and I'm not happy about that, but they were thrilled because we saved them over $1.2 million in taxes. And had we been able to do that sale with the wrapper around it, they would have paid zero in tax and yet still got the deduction. So I know I've been talking fast. I promised I was going to keep this within 30 minutes if at all possible. And so there you have it, the Foolproof 1031 exchange, the 30-year tax-deferred installment sale. capital gains alternative trust. Remember, capital gains taxes are optional. You don't have to pay them if you do something else, but you have to do it in advance. And then even for post-sale planning, what can you do? We can actually lower their taxes, especially on the sale of a business or on the sale of appreciated capital assets, especially like real estate, and not pay tax or significantly reduce the tax bill. So we do have some gifts for you. Not only just that $100 gift card that I'm going to get Hazel's help with in a minute, but also if you text simply to WLG in the message, but if you just send it to 22828, and then into the body of the text, just put WLG, you'll be added. I'm just reading some of the comments. Thank you for this. Thank you, Stephanie. I understand this is a lot coming at y'all. And when you're not dealing with tax kinds of things every day, it's overwhelming. So again, the point is, this is not meant to make you all experts, but it's meant to start a dialogue with us. So I'd love to have a chat with you, or any of you that are watching, listening today, or that are watching this video later. Let's talk about any prospective client situations. Again, no charge for that first 20 minutes, and just brainstorm something that might be able to work. And then let's do a webinar together, and for some of your clients or prospective clients. We offer something called quote action, which is really fun. It's the quote or something from a very famous person, followed by an action that just every day we send this out to clients. We literally send hundreds and hundreds of these out, and I've heard it over many years now that it's often the favorite email that people open during the day. There's a retirement video series that is, we actually have 10 called the top 10 planning mistakes that will keep you from retiring well. And again, we offer that 20-minute complimentary conversation. Lisa, you're so funny. My friend Lisa Romero Inouye had, when I'd asked her, Lisa, what are the issues that real estate agents are really facing? What's your perspective on that? And I got her permission to share some of these thoughts. But the greatest challenges that she's facing the clients right now is the limit on the lack of inventory. And San Diego affordability is currently at all-time low, rapidly rising inflation coupled with skyrocketing mortgage interest rates. Yeah, that is a ton of stuff all at once. It's hurting affordability, taking buyers out of the market rapidly. And when I ask, what do you feel would make it more difficult, or how can we make it more available? The issue is that for at least the next 3 to 6 months, as Lisa's pointing out, it's going to be very, very challenging. And that fortunately, she has a great database, and most of her business comes from referrals. So that's for all of us that are professionals in this business. The important thing is to have that referral network, and it's never been more important than now. But it's going to be challenging. So that's why I wanted to do this event, so you can see that there's plenty more arrows in your quiver. Again, not that you're going to be the expert, but let's have a conversation, or let's chat with some of your prospective clients and help put them at ease. It's just like my real estate friend did yesterday. Let's put them at ease that there are more options than they know about. And that's really the point of all this. So, okay. And thank you, Bethany. I appreciate that comment. Very nice of you to say that. And with that, I think we're done for today. So thanks so much for being with us. I'm RJ Kelly, Wealth Legacy Group here in town. Just so glad that you would make time to be with us. I hope this was helpful to you. And again, reach out to us. We're happy to reach out to you and just kind of brainstorm some stuff together. But with that, let's continue to pray for the country of Ukraine, for the brave people there, and just that somehow this madness would end. But for those amazing people there, and we have one who's on our tribe that is Ukrainian, our prayers and thoughts are with them. So thanks so much. God bless. It's a great business. We get to help a lot of people and love what we get to do. So thanks, everyone. Bye for now.